Download this code from codegive.com, link in the description below. OK, let's delve into the complex and often misunderstood topic of why converting your primary residence into a rental property can be a financially and tax-wise suboptimal move, despite its seeming simplicity. I'll provide a detailed explanation, covering tax implications, potential pitfalls, alternative strategies, and some illustrative code examples, primarily for calculation and decision-making rather than direct real estate transactions. Disclaimer: I am an AI chatbot and cannot provide financial or legal advice. The information provided here is for educational purposes only. Always consult with a qualified tax professional, financial advisor, and real estate attorney before making any decisions regarding your property. Why the knee-jerk reaction to convert? Many homeowners, when facing a job relocation, a desire to move to a different area, or simply seeking an investment opportunity, immediately consider converting their existing primary residence into a rental property. The logic often seems straightforward. Already own it. No need for a new mortgage, initially. Generate income. Rental income can offset mortgage payments and potentially create positive cash flow. Build equity. Tenants help pay down the mortgage, building equity over time. Defer capital gains. Delay paying capital gains tax on the appreciation of the property. While these points have some merit, the devil is in the details. The tax code, depreciation rules, and potential loss of valuable tax benefits associated with a primary residence can quickly turn this seemingly simple strategy into a less than ideal situation. The core problem: loss of the primary residence exclusion. The biggest reason to think twice about converting your primary residence to a rental property is the potential loss of the Section 121 exclusion of capital gains when you eventually sell. Section 121 exclusion, the Holy Grail U.S. tax law, allows you to exclude up to $250,000 of capital gains from the sale of your primary residence if you're single, or $500,000 if you're married filing jointly. This is a huge benefit, effectively allowing you to pocket a substantial profit tax-free. The use test. To qualify for the Section 121 exclusion, you must have owned and used the property as your primary residence for at least 2 out of the 5 years preceding the sale. This is where the conversion creates a problem. The non-qualified use rule. If you convert your primary residence to a rental property and later sell it, a portion of the capital gain may not be eligible for the Section 121 exclusion. This is proportional to the time the property was used as a rental versus the total time you owned it. Example: you own a house for 10 years. You live in it as your primary residence for 6 years, then rent it out for 4 years. When you sell, 40%, 4/10, of the capital gain will not be eligible for the Section 121 exclusion. This 40% is considered non-qualified use. Let's illustrate with code, Python. Explanation of the code. 1. Calculate _section _121 exclusion, function *. Takes the years owned, years as primary residence, the total gain, and filing status as input. Calculates the percentage of non-qualified use, time as rental. Calculates the portion of the gain attributable to non-qualified use. Calculates the portion of the gain that could be eligible for the Section 121 exclusion, before applying the limit. Determines the exclusion limit based on filing status, single or married. Applies the exclusion limit, ensuring that the amount excluded doesn't exceed $250,000, single, or $500,000, married. Returns a dictionary containing all the calculated values. 2 Example usage asterisk. Asterisk sets example values for the variables. Asterisk calls the function to perform the calculations. Asterisk prints the results, showing the eligible gain, non-qualified use gain, and the final amount of taxable gain. Running the code above will output something like this asterisk. In this scenario, $160,000 will be subject to capital gains tax. Had you sold immediately before converting to a rental, you likely could have excluded a larger portion, perhaps the entire $400,000, depending on the other conditions. Key takeaway from this example asterisk. Even though the eligible gain of $240,000 is below the $250,000 limit, the non-qualified use portion of the gain is taxable. The longer you rent, the larger the non-qualified use portion becomes, and the larger your taxable gain will be when you sell. Other tax considerations that make renting less attractive asterisk. 1. Depreciation recapture asterisk. While you can deduct depreciation expense on a rental property, which is beneficial while renting, when you eventually sell, you will have to recapture this depreciation as ordinary income, not capital gains. This can significantly increase your tax liability. The depreciation is based on the adjusted basis of the property at the time of conversion, generally the lower of fair market value or original cost, not the original purchase price. 2. Passive activity loss rules asterisk. Rental real estate is considered a passive activity by the IRS. If your adjusted gross income, AGI, is above certain thresholds, your ability to deduct rental losses against other income may be limited. This can reduce the immediate tax benefits of renting. There are exceptions for real estate professionals, but these are strict and difficult to qualify for. 3. Increased complexity asterisk. Managing a rental property adds considerable complexity to your tax return. You need to track income, expenses, depreciation, and potentially deal with various deductions and credits. This often requires professional tax preparation services, adding to your overall costs. 4. State and local taxes asterisk. Rental income is generally subject to state and local income taxes, which can further reduce your net returns. 5. Self-employment tax asterisk. While rental income itself is not subject to self-employment tax, the activities involved in managing the property, if you're actively involved, can arguably lead to some exposure, depending on how the business is structured. This is a complex area that requires professional advice. Other potential pitfalls beyond taxes asterisk. 1. Property management asterisk. Being a landlord is work. You're responsible for finding tenants, screening them, collecting rent, handling repairs, and dealing with tenant issues. If you're not prepared to handle these responsibilities, you'll need to hire a property manager, which cuts into your profits. 2. Vacancy periods asterisk. The property might sit vacant between tenants, resulting in lost rental income. 3. Maintenance and repairs asterisk. Rental properties generally require more maintenance and repairs than owner-occupied properties. Wear and tear from tenants can accelerate the need for repairs. 4. Tenant damage asterisk. Tenants might damage the property beyond normal wear and tear, requiring costly repairs. Even with a security deposit, you might not be fully compensated. 5. Legal issues asterisk. Landlord-tenant laws vary by state and locality. You need to be familiar with these laws to avoid legal problems with tenants. 6. Market fluctuations asterisk. The rental market can fluctuate. You might not always be able to charge the rent you expect, especially during economic downturns. 7. Liquidity asterisk. Real estate is not a liquid asset. It can take time to sell a property, which can be problematic if you need access to cash quickly. 8. Emotional attachment asterisk. It can be difficult to treat a former home as a purely financial investment. Emotional attachment can lead to poor decisions, such as delaying necessary repairs or being too lenient with tenants. Alternative strategies to consider. Instead of converting your primary residence to a rental, consider these alternatives. 1. Sell before moving. The simplest option is often to sell the property before you move. This allows you to take full advantage of the Section 121 exclusion and avoid the complexities of renting. You can then use the proceeds to purchase a new home or invest in other assets. 2. Short-term rental, Airbnb, VRBO. If your local laws and HOA allow it, you could consider short-term rentals. In some cases, the tax benefits can be different, and potentially more favorable than a long-term rental. However, this requires more active management and is subject to even more stringent regulations in many areas. 3. Keep as a vacation home, limited use. If you want to retain the property for personal use as a vacation home, you can limit the number of days you rent it out. The IRS has specific rules about this. If you rent it for fewer than 15 days per year, the rental income is generally tax-free. If you rent it for more than 14 days, you'll need to report the rental income and expenses. 4. Consider a 1031 exchange. If you're looking to invest in other real estate, you can consider a 1031 exchange. This allows you to defer capital gains tax by exchanging the property for a like-kind property. However, there are strict rules and deadlines that must be followed. 5. Hire a qualified CPA/tax advisor. The most important thing you can do is consult with a qualified CPA or tax advisor who can analyze your specific situation and provide personalized advice. They can help you weigh the pros and cons of each option and develop a tax-efficient strategy. Illustrative Python code, decision-making tool. This code helps you compare selling versus renting, focusing on the impact of the Section 121 exclusion and depreciation recapture. This is a simplified model, and professional financial advice is essential for real decisions. Important considerations for the code simplifications. This is a very simplified model. It doesn't account for selling costs, real estate commissions, closing costs, changes in property value, vacancy periods, property management fees, increased insurance costs, marginal tax rates. Your actual tax rate may vary based on your income. State and local taxes. Mortgage interest deductions. Depreciation recapture. The time value of money. Depreciation. The depreciation calculation is basic. It assumes a straight line depreciation method. Professional advice. Never make real estate decisions based solely on this code. Consult with a qualified professional. Running this simplified analysis, you might see output like this. This output suggests that, under these specific, and simplified, assumptions, selling now would result in a significantly higher immediate cash inflow than renting for just 1 year. However, the long-term implications of renting, potential for appreciation, mortgage paydown, are not captured in this 1-year snapshot. Conclusion. Converting your primary residence into a rental property is not a decision to be taken lightly. While it may seem like a simple way to generate income, the tax implications and potential pitfalls can be significant. Carefully consider the potential loss of the Section 121 exclusion, depreciation recapture, passive activity loss rules, and the complexities of property management. Explore alternative strategies, and always consult with a qualified tax professional, financial advisor, and real estate attorney before making any decisions. The Python code examples provided are illustrative tools for basic calculations, but they should not be used as a substitute for professional advice.